Hey, it's Rav. Welcome to Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. This show is designed to help us grow our money. You see, often the challenge is we take our time, we go to work, and if you go to work, that's a blessing, nothing wrong with that. We get a paycheck in order to eat. We take our time, we go to work, we make money so we can provide. And like I say, there's nothing wrong with that. But imagine a life where you could work a little less if you wanted to because money was making you money, and then you had the time to enjoy with family, friends, engage in a purpose greater than yourself. That is what Everyday Investor is all about. Remember, whenever you're faced with any type of investment opportunity, you always want to ask 4 questions to start. Number 1, what's the return on my investment? 2, when do I get that return along with the money that I put in? 3, what is the minimum cash amount needed? And 4, look them right into their pretty eyes and ask them, what is the risk? What is the downside to this? Super excited about this show. We don't talk about it often. We're going to be talking about how we can raise money for large deals, and we've got the guru on that topic. Marcin is joining us on this show with us. Don't go anywhere. We'll be right back.
The simplest way I always look at this, people ask me, why do I do multifamily versus single family or flips or whatever? I go, it's simple. Every time I add $1 in net income, I bump the property value by $20 to $25.
Hey guys, it's Ken from LegalSecondSuites.com. Did you know that one of the number 1 complaints that we get when we add a basement apartment into our house is noise? Noise complaints is the number 1 thing that we face. And there's lots of ways that we can minimize noise by installing the right products into our houses. There's lots of great products such as sound insulation, resilient channel, there's Sonopan, which is a sound acoustical board. There's green glue. There's lots of ways that we can mitigate noise. But the thing is you have to realize is that noise is our number 1 complaint. So if you're not doing something to mitigate noise in your project, then you're not doing it right. And I can speak from experience because I have rental properties. I have tenants who complain to me about noise coming from the adjacent unit. And one of the ways that I make my life simple with my tenants is to install soundproofing. If you have any questions about how to do it, feel free to reach out.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey guys, Omar Khan here from Theta Trading. I want to talk to you today about emotion and investing in the markets. Now, when the markets are doing really, really well, we tend to get very, very high. We're like, nothing can go wrong. And when the markets go lower and they correct, we start thinking the end of the world's coming and nothing can be worse. The idea is to never get high and never get too low. Always remain even-keeled. Stay within your framework. Don't get too exuberant. Don't get too down. Remember, the markets work in cycles. The idea is to be in high-quality stocks for a long period of time. Don't let your emotion destroy your investments. Back to you, and we'll see you next week, guys.
Hey, it's Rav. Welcome back to Everyday Investor. Today we're going to learn how we can make money by raising money for our big deals that we do. I'm talking to my friend Marcin. Marcin, thanks so much for being on the show.
Hey, really happy to be here. Thanks for having me.
Yes, and I know you're a very stylish guy. You probably wouldn't be wearing that color in the dead of winter, so it tells me you're not in the GTA right now. Where are you?
No, I'm down in Florida right now.
Where are you in Florida?
Jacksonville Beach.
Jacksonville Beach, okay.
That's right.
Yeah, I've heard lots of great things about Jacksonville. I've never been up that way because usually, I just got back a few weeks ago, but I want to be in the ocean. I'm a beach bum. All the locals think I'm crazy, so I try to go as far south, on the Gulf side, calm water, so kind of the Naples area. Tell me a little bit about Jacksonville, and are you there in Jacksonville for leisure, for business, or for both? Meaning, I know you're relaxing there right now, but are you investing in Jacksonville as well?
Yeah. Actually, I'm trying to invest. I was the market down here is actually pretty crazy right now. We were best and final. I bid on 160 doors literally just 2 weeks ago, and the whisper on it was 20. I thought I could get it for 20. It ended up selling for I think 23 or 24. So, it's popping down here, man. Things are really moving fast. There's a lot of people, a lot of money. If you Google Jacksonville now, everyone's trying to invest down here. And I like that central northern Florida theme. So anytime I can bid on a building around here, it's and actually get it, that's a good day.
And so, what are your thoughts on, because we both have mutual friends that are investors in Florida, and they're doing their homework. They're trying to do the 1% rule and all that kind of stuff. I know you're into the multifamily, large, apartment buildings, but what do you think of places like still Kissimmee, right beside Orlando there, or Tampa, or places like that more south? What are your thoughts on that versus kind of more northern Florida?
It's interesting. I bid on a motel actually closer to Orlando a few weeks ago as well. It was about 300 units. It used to be a Holiday Inn or a Days Inn. It was one of the flags like 15, 20 years ago, and it's been banged up since. And even that, I think I bid 13, it sold for 16. Like you got to get more creative. So the further south you go, the thing I'm seeing is you got to get more and more creative, because those gift wrap deals of here you go, multifamily, there's a couple $100 in the rent, would you like to buy it? Those deals, unless someone else has got contacts, I don't, that stuff's not happening right now. But the more central and northern you go, you're able to do things that look a little bit more traditional multifamily. So.
Yeah, no, I like it. Go where the numbers work.
Yeah.
And, and really it's just about numbers. I mean, if you can be in the sunshine and make money, why not? But if there's no money to be made in Florida, I guess you wouldn't be there. So, and so who are you with there? You're with yourself, your family? How long are you there for? What's kind of, tell me a little bit about Marcin and how you kind of got started. I know it was, 15, 20 years ago, and here you have almost, 1,500 to 2,000 units. So kind of talk to us about the story and how long are you in Florida right now?
Sure. Yeah. No, I got down here January. I'm typically here for 3-4 months at the beginning of the year, and then maybe pick up a little bit before the holidays. I'm a traditional Canadian, so I try to avoid that 35 to 45 degree heat down here. So usually by June, I'm good. I'm ready to go. You can cook an egg on the sidewalk down here, so it's different. My background, I started out in PE about 15, 16 years ago, private equity. Went from buying houses in Oakville in that Niagara region, because I grew up in the GTA myself, to getting recruited by a PE firm, moved out west, and then immediately just got thrust into, 200, 300 unit acquisitions, land assemblies, syndications. I'm Googling words in these meetings to understand what's going on, right? Because you're in a room with people that, they're not going to teach you how to count while they're doing algebra, right? So you need to be already, operating. So, started out.
Hold that thought for a sec, Marcin, because it's an important point. I mean, I work with private equity and, capital and absorption rates and liquidity and, accredited, eligible, like. Can't we call raising capital just raising money? Can't we call absorption just how many people? Like, why do we do this? Why? Tell me your thoughts on, like, to me, simplicity wins every single time. Authenticity wins every single time. But I think what makes it hard, and hence the show, Everyday Investor, the show is all about not dumbing it down, but just making it simple. Because as you just said, it really is just basic knowledge, but, we get caught up in all these big words. And why do you think that is? Are we just trying to big it up? Are we trying to be ultra sophisticated? What is it?
Well, I think the more zeros that go on a piece of paper, the more compelled you feel to make it sound like something more than it is potentially. That said, I mean, when you're dealing with an when you're dealing with an investor that's going to write you a check for 10 grand or 100 grand, that's typically a different human that's somebody going to write you a 7 or 8 figure check. So you start having totally different discussions. Initially you're talking about just basic ROI, return on investment. And then you get into the institutional stuff and you're looking at return on equity, internal rates of return, cash on cash, going in cap rates, exit cap rates. You're right. And it all, if you want to boil it down, is what is the return on your investment? But you're right. At least I've noticed, as the checks get bigger, the language and the level of acuity required to actually have that discussion, it does increase exponentially for sure.
Yeah. I don't know. Maybe I'm just lazy to learn it all. I mean, I know it, but I refuse to talk like that, because to me, it doesn't make sense to. It's just the words are too big. But anyway, so go on. So you were working in private equity, and then you started you wanted to do your own thing, like create your own equity firm?
Yeah. So Rav, I'll tell you a quick story. One of my favorite buddies, worth a tremendous amount of money. He's just like that. He says to me, he goes, yeah. So I put $1 million in. What do I get back? And it's just like you, right? Like, tell me the in, tell me the out. I don't care what you call it in between. What does it look like? Like, I can't spend statistics, right? So tell me what it actually is, right?
No, and I love that story, because I mean, you're going to teach us, and you've raised, millions and millions of dollars. But I'm sure I join your mastermind. The first thing you're going to say, or one of the first things you're going to say, is trust. I trust Marcin. Like, I don't care what Marcin does. I want to know a little bit. I don't want to be so ignorant, to not know what you're doing. I want to know what you're doing. But if I'm writing a big check to Marcin, I'm really writing it because I trust you, right? I don't need to know A to Z per se and get in depth and like who really reads the entire prospectus, or who really reads the entire offering memorandum. Like, we don't do that. I trust Marcin, or I don't. And so therefore, give me the bottom line, give me a little peripheral, and I'm good.
Yeah. Well, and you're right. Relationships are really what make the capital world work. I mean, ultimately, if you're raising 6, 7, 8 figures, whatever it is, 9-figure commitments, you're ultimately looking for that trust factor. But the one thing, Rav, I'll share with you is, if you do go and raise those larger checks, whether it's from institutional investors or family offices or the like, you do then need to speak the language, because they denominate everything in that language, right? That becomes commonplace. So you're right. Ultimately, you got to be able to break it all down to me in a way that makes sense to the everyday person. They're not going to understand what a cap rate compression means. They're not going to look at, yields are increasing, so this is going to happen with, like that's not how people talk. So yeah, making it relatable is important, but that trust piece that you're talking about is so important. And that really does come from breaking something down to a point where someone understands it. One of my mentors always said, confused mind doesn't buy. And you may sound really smart and really articulate, and you need to know your audience, because if you're in front of a commercial banker, that's when you're busting out the DCSRs, the going in debt yields, you're talking cap rates, you're talking about absorption rates, vacancy rates, shock factors, all this stuff. But when you're dealing with somebody who's built and sold a company and they're thinking of writing you a 6 or 7-figure check, don't try to sound like a banker, because they're going to look at you and say, oh, you're really smart. That's cool, but I didn't understand anything you said. They're not going to tell you that, but you're going to create a barrier between you and them.
It makes sense. Do as the Romans would do in Rome, and but again, Leonardo da Vinci, he says the simplicity is the ultimate sophistication, right?
Oh, 100%. 100%.
Again, I got to know who I'm talking to, and so really wise words. Okay, so we got a few minutes before we go to break. So take me. So you work with large. Like, how did you get to 1,500 units and raising millions of dollars? Was that when you did it for another company, and then you started your own private equity firm?
Yeah, so I started out in the space, and I mean, I've sourced 9 figures in private capital, private equity capital. It's helped acquire over 1,500 doors over the years. And, the story starts out with me working with a PE firm and just really drinking from a fire hose, literally just trying to figure everything out, 200, 300, 400 unit acquisitions, land assemblies, things like this. And then when my time was done there after a few years, I couldn't go back to just buying duplexes or flipping houses anymore, because I saw the game at a different level, and one's not better than the other. It's just It's what I was now passionate about, excited about, right? And over the years, we've been able to buy in Tennessee. Now we're looking at Florida, a few other markets as well. And the theme is always the same. I mean, ultimately, with the simplest way I always look at this, people ask me, why do I do multifamily versus single family or flips or whatever? I go, it's simple. Every time I add $1 in net income, I bump the property value by $20 to $25. That's real money that you realize by your effort, not by the whims of what's happening in the market. And that's
so what you just said there, people are going to find hard. It's hard to believe that.
Yeah.
When we come back from the break, we'll look at those numbers of how you do it, the formula, cap rate, value, income. So you'll teach us that on a real case. So go on. So when people ask you, you're saying you're putting in $1 and lifting it $20.
Well, yeah. I mean, look, and you don't even put in the dollar. Like when you have income on a multifamily property, your net income, and this is what we're going to talk about, your net income, if it goes up by $1, if you apply the market cap rate, the value that the market applies to that net income, in most markets, that extra $1 in net income generates $20 to $25 in real value in the property. You can borrow against that. You can sell that. You can do a lot of things with that extra $1 that's now worth 20.
Good stuff, man. Appreciate it. Let's take a quick break and let's jump into some numbers. We're talking to our good friend Marcin. He's teaching us how we can raise money for large deals. Don't go anywhere. We'll be right back.
Hey, it's Kyle from the Kyle Ford Mortgage Team. As you've heard me speak on the Everyday Investor, we often talk about recapturing equity in our home, looking at refinancing, adding a HELOC, and tapping into that equity. What are some things that we could do with that? The answer is you could do whatever you want. You could buy a boat, go shopping, or buy a new car. I would recommend none of those things. You could also look at investing in new rental properties, land development, or private lending. Let me give you a real life example. If we were to borrow $100,000 from our home at 3% a year, that would cost us $3,000. If we were to lend that same money at 10%, that would be $10,000. You would get the spread, $7,000 a year. That may not be a helicopter, that may not be a Ferrari, but that could be money that helps support you and your family's lifestyle. If you took $1 million, it would cost you $30,000 a year. At the same 10% would be a gross $100,000 a year, netting you out $70,000 a year. This is an entire income replacement for many families. This is the type of money that can allow people to retire substantially earlier. If you have questions about options and different things that you could do, don't hesitate to reach out to myself and the Kyle Ford Mortgage Team. Happy to help.
You've always dreamed of having rental income, but buying a rental property? Well, that's a tall order. Capitalize on the space in your home instead. Renovate and rent out that space with ease with LegalSecondSuites.com and the team at Wise Construction Group. With LegalSecondSuites.com, our talented team of BCIN designers, engineers, carpenters, and tradespeople can transform that unused space into a beautiful, legal, and safe rental unit. We're empowering the everyday homeowner to become an extraordinary landlord. Get more out of your home. Visit LegalSecondSuites.com for more information.
Hey, it's Rav. Welcome back to Everyday Investor. We're talking to Marcin, who is in Florida. I'm jealous. And he is going to teach us really the numbers on why he loves investing in multifamily. But more importantly, he's going to talk to us about how we can raise money for these large deals. So Marcin, let's look at the numbers really for, right now on an active deal or a deal that you've just done.
Yeah, sure. So, Rav, this is the most important part for somebody to be able to articulate the value in a deal to an investor in 30 seconds or less. And I'll give you the 30-second pitch as if you were somebody who I was potentially going to work with, and then we'll break it down piece by piece, right? So there's a building that we paid about $3 million for. It's going to require $2 million in renos. And by the time we're done, the building will be worth about $11 million.
That's interesting. You have my attention.
And that's the point. Most people, when they talk to people, they ramble on about all kinds of minutia. And anybody with real money is going to want to understand where the deal is. They don't necessarily care about the corner of Main and Main Street until they understand how they can monetize that, right?
So,
and if you
you're saying purchase price $3 million, $2 million in renos, so $5 million, and I know we're not using $5 million because we're leveraging, we're not buying this for cash, but even if it was $5 million, you're saying I can more than double my money in how long? Like 50 years, or how long does this take?
The full in cycle will be about 24 months.
So in 2 years, so this is over 50% return. You're saying that if somebody were to do this just cash out of pocket. Now there's more intricacies, but
right.
Yeah, man, you have my attention. So how does this work?
Right. So whenever I talk to somebody, the first thing I do is I break down the numbers at a core. So let me give you the backstory on this deal. It's in Memphis, Tennessee. It's about 180 doors. And the seller was looking to retire, move back to Vegas, and just basically live out his years. Bought the building for next to nothing. Didn't want to spend any money on it. So literally 2/3 of this building is empty. 2/3 of it, out of 180 doors, 2/3 of it is empty. So you've got maybe 60 units occupied at most. The other 2/3 of the building are literally boarded up. It's like the kind of stuff you and I, Rav, would read about in like real estate textbooks about, hey, where do you find deals? Where do you find value? And if you're sitting there and you're thinking to yourself, well, how do you buy that many doors for $3 million? Well, number one, the US is a totally different place than Canada. Toronto, you get maybe 2 condos and a parking spot, for $3 million. Like that's your going in rate. But down in the southeast, you've got Tennessee, you've got Arkansas, you've got Florida, Georgia. These types of deals exist still. They're not just in textbooks. You got to look for them, but they're there in major markets. So the backstory here, again, 180 doors, purchase prices. It was a tad over $3 million, but call it $3 million. And we were, number one, able to assume existing financing on the property. So we only had to put in about $2 million USD to acquire it. And the actual renos themselves, once you have a lender that understands your plan, they'll actually fund your CapEx 100% of the way. So CapEx is your capital expenditures, right? So in the US, the capital markets are also so much deeper. Like I've got, Rav, I should show you some of the term sheets I got on the last deal I just got outbid on. They'll literally be like, okay, we'll do 75% LTC or LTV, whichever is greater or lower, pardon me, and we'll fund 100% of your CapEx, and we'll do 3-1-1 on interest only terms. I'm just like, really? Like 5-year bridge money? They're like, yeah, no problem. And we'll pay for your rentals. Like it's a different game, right? But my point is going back to this story. So you've got your acquisition of 3 million, your rentals are 2. How you get the value of 11 is what you do is you look at your out on the way in. And again, we talked about cap rates earlier. So I'll give you some numbers. Right now, the building, when we bought the building, the cap rate was negative. It was technically right.
Okay.
So listen to this. The building didn't carry itself, literally. So the NOI, the net income, was negative. So if it's negative, you can't count a cap rate. It doesn't exist.
So how did you find this property?
It was across the street from another property we bought. So we literally bought a property down the street, got to know the owner. He liked us quite a bit, and started talking to him. I joked like, "Hey, let us buy your building." He was like, "We'll put in an offer." I'm like, "Okay." Now, as I said to you, the cap rates determine the value of commercial property. So that's a double-edged sword, because if you have no income, then what is this thing worth? And then it becomes kind of like a best guesstimate, right? And then someone like me will look at that, and I'm not scared of negative income because I know what it takes to bring it back. I mean, you build in some contingencies, some working capital to get yourself back on track. And I looked at this thing really simply. I said 180 doors. I looked down the street one way, I looked down the street the other way. Rents in the area, $700 to $900 for a 2-bed, 2-bath. So I did my math, and I knew that the gross potential rent, which is your top line number for the year, was about $1.45 million. So that's an important number, because you got $1.45 million in potential rent. So what goes into that equation? You factor in your reasonable assumptions for the rent, for the vacancy, for bad debt. Pretend this thing is running the way it's supposed to be. And what would you be able to rent for compared to everywhere else in the market, factor in your vacancy rates. And then going the next level down, you have what's called your net income. So you have all the operating expenses below the 1.5. So to get to your NOI, you have to subtract things like your operating costs. Like you've got your insurance, you've got your taxes, you've got repairs and maintenance, administration, everything that it costs to run the building. And anybody who runs multifamily assets will tell you that your operating costs are typically at least 50 to 60, maybe 65% of your potential rent. That's just the math. That's how it works. You might be less than that if you're running a brand new building, but stuff breaks. And in older buildings, more stuff will break because it's an older building. So I did the back of the napkin. I said, okay, let's assume it's going to be a really heavy operating expense, and there's going to be at least 50% of expenses, which is high. That's pretty high. So we got NOI of about $750,000.
Okay.
And again, I'm rounding things off a little bit just to kind of give people some context here. And then your NOI is 750. So remember we were talking about what is the cap rate? Well, if I bought this building for cash, then the NOI would determine what the cap rate is. So for example, because I paid $3 million for this building, add the $2 million too. So I paid $5 million. The 3 plus 2 is the 5. You would take the 5 million and divide it by 750. That cap rate is crazy. I think we're at like 15. And so for 15? Anybody, 750 divided by 5 million is a 15% cap rate.
Okay.
That's insane. So the way you determine what the property is worth in the market, because that's your cap rate, that's what you've crystallized as an investor.
The 750 divided by the 15%, yeah?
Well, divided by the 5 million. The 5 million was what I paid, remember? Because I paid 3 million plus the 2 million in renos, so I got 5.
Okay.
And then the 5 million divided by the 750, that's your 15% cap rate, right?
Yeah. No, I'm saying to value. To get to value, NOI divided by cap rate, yeah?
Right. Well, so that's my cap rate. That's not the value of the property because I paid 5 million. Because remember, there's 3 factors. There's the going in cost base, there's your NOI, and then there's your cap rate. Now, if you want to solve for the value in the market, you got to use the right cap rate.
Yes.
So for that market, the cap rate. In
this case.
So the market cap rate for that asset in that market is about 7%. The cap rate is 7%. So you would take the 7% and divide it by the 750. And I'll tell you right now, it is $10.7 million.
10.7.
10.7, right? So again, it's probably closer to 11. I didn't give you the exact number, but that's where the value is in this. Now check this out. The bank is going to look at that value for refinancing because you got $750,000 per year in free working capital. That's real money. So the bank is going to look at the value from a financial perspective, and they'll give you that $11 million valuation. And then you can refinance. You're doing a super burr, essentially, is what you're really doing. And I prefer to refinance rather than sell, because if you refinance, you defer that tax obligation even further.
Yeah.
Right?
No, listen, Marcin, this is great stuff. You bought for 5. You showed us how we turned it into 11. Listen, when we're learning and having fun, time flies. And so that's all the time we have. But we didn't get to talk about, how to raise capital. Tell me really quickly, we'll put it on the screen. Where can we reach you on that?
Sure. My website's the best place. We host a lot of different masterminds throughout the year. My website's first name, last name.com, marcindrozdz.com. And depending on when it is, we've got masterminds, we've got boot camps, we do all kinds of stuff. And, we have people attend that have 2 doors. We have people that attend that have 200 doors. So it's really a pretty open format for a lot of people.
Well, thanks for doing that and for helping people. Really appreciate having you on the show, and we'll have to have you back. Thanks so much. And thank you guys for watching. Without you, we would not have a show. Remember, if you want to go through these numbers again, if you want to watch previous episodes right on demand, make sure you visit our YouTube channel. Until then, we'll see you next week. Same place, same time. Honey, love you. I'll be home soon. Bye, everyone.